Okay, class number 4. Okay, so last class we covered the two main topics we covered last class that were kind of significant and new was step 5 and step 6. Right? This was step 5 was the FIN 48 exposures, reserves, and then step 6 was evaluation allowance. So that's what we were talking about as a contra asset that we might need to the extent that we don't have future profits. We can't use our deferreds because we don't have tax to save with those deferred tax assets. Right? So so tonight we're going to try to hit 7 through 10. Which means we're done after class 4. You guys can have the rest of the quarter off. Okay. So the goal is at the end of tonight, you'll be able to start with step 1, identify perms and temps, figure out how to do a current provision, figure out how to do a deferred provision, go all the way through a rate rec, disclosures, get the whole thing settled. Okay. So the goal at the end of class 4 is that you could compute a provision from beginning to end, and you could get the required disclosures. All right? And so the problem that we're going to do towards the middle part of the class is a comprehensive 2-year problem. We'll do the year 1 provision, we'll get our accounts all settled, we'll book our entries, we'll do our disclosures, and then we'll kind of move on to year 2. And this is good practice for the final, because the final is a multi-year take-home. It'll be more complicated than this, but it'll be a similar kind of 2-year exercise. Okay? But think of tonight's problem as we might need to do all 10 steps. Okay? I don't recall what the facts of the example are exactly and whether they touch on all 10, but the goal of the example would be to illustrate beginning to end provision. Okay? Okay, so step 7 was computing the total provision. So this is pretty straightforward, given that the total provision is just the sum of the parts, right? And what we've been learning in the prior classes is how to calculate each of these things, right? We've talked about how to calculate the current, how to calculate the deferred, and then on a non-current, that's what we covered in, this was step number 5 in our series, and that's what Now was just talking about, being slightly confused about. And so remember, you could assign a journal entry to each one of these things, and for example, like the journal entry that would generally go with this would be debit expense, credit liability, because we would tend to accrue a liability for exposures, and we would book a corresponding expense. Okay? So if you thought of all those boxes as individual journal entries, each of them might have elements of a provision. It kind of depends whether it's debit or credit. But in this FIN 48 box, we might accrue an expense to record a liability. We could do the same thing for the current, same thing for deferred, add them up, total provision. All right? Okay, so this slide is literally the words that go with the picture we just looked at, right? And I'm more of a picture person than a words person, but all this is saying is kind of our step 1, 2, 3, right? Do the current, do the deferred, let the provision balance your entry, out you go. The only thing that's potentially confusing about this, I think, is, you know, when we talk about steps 1, 2, 3, we don't focus so much on this, and again, this is that UTB thing we were just talking about. But think of it as like another part of step 1, right? Not only are we accruing the taxes that we owe and we're going to pay, but think of us as having to accrue the taxes we probably ought to pay, but don't feel like paying, right? That's all that that section is. It's just another variation of step 1. Okay, so this will probably seem a little remedial, honestly, but so a couple of terminology points. Hopefully this is pretty straight by now in your head. So in the first class, we talked about differentiating statutory rate from effective rate. And I think at this point, you all get that the statutory rate is the enacted rate. So if I'm a corporation and I have $1 of income, I pay a 35% tax on that incremental $1 of income, so my statutory rate is 35%. Right? My effective rate, right, my ETR, my effective rate is, you better not miss this when it's on the exam. My effective rate is my provision divided by my pre-tax income. Right, so that could be the same as the statutory rate, but it could easily be different because of all the things that impact your effective rate. Right? Okay, so then the twist with this slide, relative to what we've covered before, is this concept of a blended rate. Okay. So this is pretty easy, but when take a U.S. company, a U.S. company is subject not only to federal taxes, but also to state taxes. Right? So if somebody wanted to say, oh, well, I've got $1 of income, what's my incremental tax rate? It's really the combination of federal and state taxes, right? So if you have $1 of income, both jurisdictions are going to tax it. So if we added up our incremental federal rate, and in this example our incremental state rate is 7%, because we get this federal deduction for state tax, we have a federal benefit of state. Our state rate isn't really 7. Our state rate is really 7 net of the benefit of the federal deduction. Right? So that net state rate is the combination of these two things. So some people would say, well, my blended rate is this. Right? Because really, when I have $1 of income as a corporation, the tax I'm really paying is a combination of federal and state, and then offset partially by that federal deduction. So if people are talking about what's your blended rate, they're talking about the blending of your statutory rates. Okay? Totally different than effective rate. It's just a blending of statutory rates when the same $1 of income is taxed in multiple jurisdictions.
So if you file, say, 40 plus state tax returns, then do you have to add those with the federal rate and do this benefit?
Most large companies, when they calculate their provision, when they calculate their state provision, they use a blended rate. That's not always the case. I mean, I have clients that, in the biggest company that I work for, they do their calculations state by state, and they do hundreds of them. So they have an individual provision for each state. But other companies, so for example, like our next guest speaker, she uses a blended rate for her states. And they just take kind of the weighting of apportionment and tax rates, blend it all together, and boom, that's their blended rate. Okay. All right, I think this problem is going to seem really basic. So, but let's just go through it. It'll give you confidence so that when we get to a harder problem, you'll either feel better or worse, depending on your perspective. Okay, so this is one we'll just kind of review together using the set materials here. And make sure you ask questions as we go, but I think you'll find that this is repeating what we've covered before. And remember that the goal of this class is to package it all together, okay? All right, so in this example, the company has income, net income is $1 million, and that's after federal tax of $300. So what that's trying to tell us is that our profit before tax is 1.3, right? So we know that our PBT is 1.3 million. The company also has these temps and perms. Okay, so depreciation. So Catherine, is depreciation a perm or temp? Temp. And is there two Catherines? All right. Meals and entertainment. Jose, what's meals and entertainment? No, is it perm or temp? Perm. was thinking about how your brother didn't get that pizza last week. What's that? Oh, he's a vegetarian? Oh, yeah, the vegetarian was gone. Okay, that wouldn't work out for you then, huh? Alright. Okay, 263A adjustment. Nellie, is that perm or temp? Or? Temp. Yeah. Okay, why is that temp? Who knows? Vicky, why is that temp? So 263A, for those of you who don't know, is the tax law says some of your G&A costs could arguably relate to inventory. So you should deduct those G&A not when you spend the G&A, but when you sell the related inventory. So they make you defer the deduction for G&A until you sell inventory. So books doesn't have 263A. So for tax, you get a deduction for G&A later than for books. It's almost like a super cost of goods sold concept for tax only, where we in tax have to defer deductions, okay? But we get the deduction, we just get it later. So it's a timing difference. Non-deductible fines and penalties. Violet. Perm or temp? Perm. Okay, 199 deduction. Philip. Perm. Bad debt reserve. Devin. Temp. Bonuses accrued but not paid within 2.5 months. Scarlett. I could barely hear you. I thought I heard you, but I wasn't sure. What? Temporary. Gonna work on Scarlett's volume. Okay, our federal tax rate is 35%, our state rate is 7%. Okay, so our problems: compute the current, compute the deferreds, figure out the expense, prepare the journal entries, right? You sum all that up, that's do a provision. Okay, that's those 5 questions, that's code for do the provision. Okay? Other questions: what's our stat rate, effective rate, and blended rate? Okay, so hopefully by going through that we can confirm that we understand what the 3 different rates are. Okay, so let's figure this thing out. So our net income, I don't have the problem in front of me, so you guys are going to have to help me with the numbers, or I'll flip to the slide so I figure it out too. Okay, net income before books. Hop, what was our PBT? 1.3. You got lots of friends. Okay, our 50% of meals and entertainment, Jose, was what? 5,000. Penalties was 2,000, right? 199 deduction. How much was that, Philip? Was that add back or a deduction? Based on the word deduction in the phrase 199 deduction, that is a good guess. Okay. Additional tax depreciation. How much was that? 75? Is that a additional, is that an add back or a deduction? Megan? Deduction. 263A cost. How much is that? 50,000. Okay. Is that an add back or a deduction? Add back.
Can you explain why is the deduction for the tax depreciation?
Hop's question is, why is it a deduction for depreciation? The reason is because we say it's additional tax depreciation. So the assumption is that whatever book depreciation was, tax is additional by 75.
Therefore, we need to deduct it.
We gotta deduct it now, and we'll suffer the reversal of that down the road. Bad debt accruals. So our bad debt accruals was 45,000. Okay. Is that an add back or a deduction? Okay. Add back. When do we get to deduct that? Okay. when we write off the AR. In the future would have been a good answer too. That's fine. Accrued bonuses not paid. Accrued bonuses is 30,000, right? Okay, so if I add all those numbers up, I got 1343. Okay, that's my taxable income before state tax deduction, right? Okay, so my state rates was 7%, and my state expense is $94,010, right? So I just did step 1 for state, right? I figured out my current payable for state. Okay, my federal taxable income. So now I'm going to move on to step 1 for federal while I'm on the topic of a current provision, right? Okay, so my federal taxable income after my state deduction. So Tejal, how would I figure that out? How would I figure out federal taxable income after my state deduction?
That can be taxable income before state deduction reduced by state tax provision. Sorry, state tax expense.
Use numbers.
Oh, it's 1,243,000 minus 94,010.
Right, so it's
That comes to 1,248,990.
1,248,990. We get a deduction this year for the state taxes we're going to pay this year, because the assumption, at least in this example, is we're on a current deduction method. Our rate is 35%. So that means we have tax of 437, 147, and that is step 1 for federal. Our total current provision is 531, 157. Okay? Step 1. We all good with that? Okay. So here it is in much more legible writing. Okay. So Ming, after we do step 1, what do we do next? You can ask a friend for help, that's fine. So we figured out our current payable. Now what are we going to do? Deferred taxes, right? Okay. So let's move on to deferred tax. So the template for the solution is kind enough to give us the 4 different temp items that we have. So we're going to label these things as either future income items or future deduction items. Right? Behind. So bad debt reserve, is that a DTL for future income or a DTA for future deduction? DTA. So we're going to get a future deduction of 45,000, right? At this point, we're only dealing with pre-tax numbers. We're dealing with deductions and income, not with tax-effective numbers. Okay, Lou, is accrued bonus a future income item or a future deduction item? A DTA. So that's 30,000 of future deduction. Depreciation, Isabella, is that future income or deduction? DTA. Or? DTL. Oh, is that what you said? Sorry. It's a long distance call from all the way back there. Okay, so that's future income. That was a little confusing because it's not so much income as it is we're just not going to get as much tax depreciation as books will. But you could also think of it as future income. If I just sold my asset for cash at book value, I'd have a gain, right? That's the future income. Okay, 263A, Olga. Is that a future income item or a future deduction item? The future deduction item of 50,000. Okay, so if I add these guys up, I got 75 here, and 125 here. So I have a net 50, right? And here, the way at least this example is working is we're going to do the deferred using a blended rate. Okay? I would not recommend this when you're doing your exam. If I were you, I would do state, and I would get state all perfect, and I would make state entries balance, and you can even do a state rate rec, and then I would move on to federal, but at least this example is trying to show you you could do it together if you wanted to. So if I take my blended rate, what's my blended rate? I have 35, 7, and then I have minus 35% times 7%. So that answer is 39.55. Right? So my blended rate is 39.55%. So my deferreds in total are 19,775. So that is step 2 for both Fed and state combined. Right? So step 1 was to debit expense for 531, credit payable for 531, right? That's what this is. Oops. Step 2, now with neater handwriting, is debit DTA 19, credit provision 19, right? And that DTA is coming from that. At the moment, I'm not really worried about liabilities and assets. I'm just dealing with the net balance with this at this point. Okay?
Well, I'm trying to figure out where you got the 19. I see the 49.
Where I got the 19 was I summed these up. That's 50. If I take 50 times 40%, that would be 20. This rate's slightly less than 40%, so that's how you get 19. Catherine. We'll do that in the problem. Yeah. Okay, we'll do it in the problem. Yeah, if you ever have an issue, do not do it like this, right? The worst thing you can do when you struggle is combining a bunch of stuff, because then you won't be clear on what you got wrong. So, you know, the way to do this is to break federal and state apart and do them almost completely independently. And then if you can't get one of those to work, we'll break it down and do a journal entry by journal entry. Right? What's the journal entry for book income? What's the journal entry for depreciation? Break it down to the smallest element until you're like, I can't figure it out anymore, right? Because you'll go low enough where it will work. That is the way to solve this. Okay? When we get to a big multi-year problem, if you want to do every little assumption in a journal entry format, you're going to have a lot of journal entries. So that's not, there's a point of diminishing returns on that, but in this class, in terms of the volume we're dealing with, you could pull that off. So if you struggle with kind of too many numbers coming together in the step 1 and then the step 2, break it down and do every fact as if it's its own provision where you have to come up with the journal entry, right? We did that in the first class. Just revert back to that method. That'll work. Okay, so we basically have said that because our deferred assets increased by 19, then we must have a deferred expense, a deferred provision benefit, deferred expense, but actually we have a benefit of 19, right? And again, just to repeat, our step 2 had a debit DTA, credit provision.
You got a benefit of the 19,775.
That's right. Okay, so now we got to compute our total expense. We did step 1. We did the payable. That was 531. We debited expense, credited payable for 531. Right? We did our deferred provision where we debited DTA, credited provision for 19. Okay, so now we're trying to do our total provision. Veronica, so how would I calculate my total provision? Tell me how to do this thing where I'm just highlighting right there. $531. $19. So that's $512. Right? The total provision is $512.
Yeah, I have the 19,775 and of course, the 511, because we knew that cashier, but, okay,
Okay? Alright, so now this section of the page is trying to do a rate rec. It's doing a rate rec a little different than we've done the rate recs before because it's trying to continue with this blended rate theory. Okay? So rather than breaking out Fed and state separately, this one's basically saying, hey, let's just take book income, your perms, and apply it to a blended statutory rate. Because we're going to get the right answer. Okay? So our book income, Sam, what was our book income? 1.3. Okay. Our perm items. Our perm items are the guys with P's. Meals and entertainment of 5, non-deductible penalties of 2, and $199 of 14. So if I add that up, that's an add back of 5, an add back of 2, and a deduction of 14. So that's a net deduction of 7, right? So if I put in here a net deduction of 7, this is 1293. My blended rate we calculated before was 39.55, and that is going to be 512. It's actually like 511 and change, but the point being that this number here and that number here are the same thing. Okay? And that's really basic for you guys because the rate rec is just proving that only perm items drive our provision, right? That's all that's doing. Okay. What are our statutory rates? Joe, what are our statutory rates? 35. And 7. Okay. What is our effective tax rate? Asmita, what is our effective tax rate? Our effective tax rate, I think what Asmita is saying is it's 511, this number, divided by 1.3 million. $39.39? I can't hear you, sorry. 31. Or 24.
39.34.
Oh, 34, okay. Hop, you're going to be the designated calculator guy today. You're sitting front and center. Or computer guy, whatever. You're the math guy. Okay, our effective rate is 39.34. $39.34. Okay, and what is our blended state rate, Studi? 39.55. Okay, so one of the points of this exercise is to show If somebody says, what's your tax rate? You have to ask, which tax rate are you talking about, right? You're talking about my federal rate, my state rate, my effective rate, my blended rate, right? So out of that calculation, we ought to be able to figure out all those rates. Okay? CFO only cares about effective rate, but tax people, they care about other rates too. All right? Okay. Okay, so that is pulling the provision all together. All right, now step 8. The materials on step 8 are pretty minimal, but I think what you'll find is, or at least what I can tell you from experience, is step 8 is the most important step of all. So a lot of times clients will send me their provision and they'll send it without this step done. And they'll say, oh, I've done my provision, here it is, but I haven't posted my journal entries and I haven't proved all my account balances. And I'll be like, hey, I'll wait, man. I'll wait until you figure that out. Because sometimes when you run all the calculations, if the numbers you end up getting as a result of your journal entries don't make sense at the end of the day, well, then that's not a good answer, right? So once you've calculated the provision, right, you did step 1 payable, you do step 2 deferred, the provision pops out, you do your rate rec, it all balances, you still have to book your journal entries, and then what you're left with is balances at the end of the year, right? You have a balance that goes in your provision for the income statement, you have a payable balance that is reported on your balance sheet, you have deferreds that are reported on your balance sheet. And what we're going to want to do is make sure that those balances actually make sense at a point in time. Like whatever we accrue our payable as, that better be the amount we think we owe the government. Right? If we accrue $100 payable and then the compliance team's like, yeah, we only owe like $60. Well, this is not good, right? We need to be in sync with what that balance is on the balance sheet. It's got to actually represent reality at the end of the day. And you might be thinking, well, if I did my provision right, it's going to all work. And yeah, that's right, but as soon as you start throwing a million numbers into the picture, it's really hard to kind of see straight anymore. So step 8 is critical because you will actually look at what your balances are and prove that those balances are what you really want to end up with. Okay? Reconciling tax accounts. Companies use various approaches for this, man, and that is an understatement. When we go through the example in a bit, the bigger in-class example, I'll show you kind of my approach to it, and you can see if you like that or take a different approach. But the key to me is that we understand not just the journal entry we book for the provision, right? That's this. That's the journal entry you guys have been hearing about in class so far. But there's other stuff, right? Like if we made a payment, we got to book a journal entry for that. So if we made a $100 payment, Connie, what would be the journal entry you think we would book for reflecting a $100 payment to the IRS? Debit payable, credit cash. All right. So that's right. So let's say that your provision was 100 and you paid in 80. Well, after you book the journal entry for this, for 100, and you book your payable for 80, your ending balance in that payable better be 20, right? So I know that seems really simple, but trust me, I mean, sometimes you make a lot of payments to a lot of jurisdictions, and you amended a return for 5 years ago, and you made a payment, and then you got an assessment for screwing up a return, and you made another payment, and things get really messy when you start adding a lot of facts, and then pretty soon you're like, hey, what's that ending payable balance? That's a big number, right? And then inevitably some provision person will be like, I don't even know, you know. And that is not good. The answer, I don't know, is not good. You'll see starting next class, we'll start booking entries to equity. And that'll get really messy. So then you're going to want to understand not only your payable and deferred and cash balances, but now you got to figure out why you booked entries to APIC, right? And whether that makes any sense. And so now the accounting guys who normally would be like, hey, you don't book entries to APIC, you're a tax person, right? We're going to explain, oh no, we're going to be hitting the APIC accounts too. So things are going to get a little more complicated. Okay, so we're going to do an account roll forward in a bit. And an account roll forward is going to look like this. Right, we're going to start. So assume that we're doing the 2010 provision. We're going to start with last year's balance. There's going to be a balance in the payable. Like when we ended 2009, there's going to be a balance here. Right? In real life, we don't start with 0. So if Nellie is doing the Oracle provision, let's say she's on her own, right? She's doing the provision. I suspect that at the end of their last fiscal year, there was some balance in the payable. They either owed money or the IRS owed them money. But there's some balance there. And somehow, some way, we got to figure out how to get down to Y, which is the balance that we either owe the IRS or are owed from the IRS at the end of the next year. So we got to figure out all the activity that happens between last year and this year and map it out. Right? And that could be a simple matter of payments. It could be the 2010 provision. And then it could be just an infinite amount of things that still affect the payable we haven't thought about, like those assessments or amended returns or whatever it is. But the goal on a roll forward schedule is to take you from last year to this year and explain row by row by row in a balanced journal entry how you did it. Okay? And what I would say, this might not sink in the abstract, but I would think of this not as how the GL booked the entries, but if Nellie could go back in time and say, man, how do I get the Oracle payable balance from last year to this year? Like, what are the big things that happened during the year? What are the payments? What are the provisions? What are the amended returns? What are the audit adjustments? I'm just going to bunch those categories and show the numbers. That's an easy way to understand it. If you looked at how many entries Oracle booked to their payable balance during the year, it might be a lot. And it might not even make any sense, right? They might book a monthly provision. They might book reclasses in and out of there. It could be a giant mess. So think of this roll forward not as what was booked in the GL every time there was a GL entry, but think of it as how you would tell the story to get from beginning to end. Okay? If somebody said, oh, how'd you get from beginning to end? You wouldn't be like, well, on January 3rd, I booked this $800 entry, and then the next day I knew I got the 800 wrong, so I booked another 100. Like, that doesn't make any sense. You would say, my total provision for the year was this number, my total payments for the year was this number, I got a refund of this other number, right? I would explain kind of the events that happened to get me from the beginning to the end. Okay? We're going to want to do that same thing with each of these accounts. Right? How did we start with a beginning balance, and how did it get to an ending balance? Okay? We got to tell the story. Like if I was a loss company and I had an NOL, I would say, oh, my NOL went up, and so my DTA went up. Makes sense, right? If I have bad debt reserve and depreciation, all that stuff moving on, well then I could kind of explain the activity in my deferreds. But ultimately, I know I'm starting with the prior year balance. Like that just is a given. The prior year balance is a real number. I have to start with it. And ultimately, I want to end with a balance that I'm happy with. Like I want to know that I have the right payable at the end of the year. I got the right receivable, right deferreds. I want to know that that ending balance is correct. And so if I can get if I can start with beginning, which I know I have to, and I want to end with the right answers, I got to tell the story of how I get there in a balanced journal entry sort of way. So with a number of companies, and maybe one of these days I'll sanitize one company's account roll forward. Like the one we just did for Yahoo, their earnings release was today. I'll bet the roll forward was probably 100 lines long, where we had all the kind of things that they booked so far in 2013. We would show it's provisions, it's amended returns, it's payments, it's this, that, and the other. And we break everything out to the level at which the story makes sense. Right? It's not nauseating detail, but every time there was an acquisition where a payable came in, we said, oh, there's a credit to the payable because we owe some money, but there's a debit to goodwill because that was a acquisition related item. So we show a journal entry for that. So with these account roll forwards, expect to see lots of detail. With the volume that we work on in class, it's going to be pretty brief, but in the real world, a good account roll forward that takes you from beginning of the year to end of the year, that is priceless. If you can take each account and understand how you start with the beginning, get to the end, and you can explain the story in a balanced journal entry sort of way, that's better than anything we've talked about so far in class. That's good stuff. One of my favorite stories from like my entire career was there was a company that was basically saying, see if I can get rid of all these marks. At the end of the day, what this thing is doing is it's basically saying, you know what, here's the balance you should have. And if this is the balance per your GL, but this is the balance you want to have, this is the as calculated balance, the difference between those two is going to be an AJE, adjusting journal entry. So if your payable is 100 on the GL and you want it to be 80, you got to book a 20 adjustment to fix it. In theory, the other side of that entry should be something that is either provision or deferred, right? It all should balance. And this AJE's got a balance within the tax accounts. And one time I was working on a roll forward, and this AJE, it didn't balance. The company basically said, hey, you need to adjust your payable, but there's no other tax account that needs to be adjusted. And I'm like, man, what happened? What is that? We have like a one-sided payable entry, right? And so we went back to this roll forward, and we're like, well, we started with our beginning balance, and then every entry we looked at to get to our ending, it all looks like it balances, because there was a little formula check over here that added up the rows, and as long as they balanced, we're like, gosh, how did we get from beginning to end, and yet our adjusting journal entry doesn't balance? It doesn't make any sense. And what the firm did that was doing the provision, one of their rows didn't balance. And what they did was they couldn't figure it out, so they deleted the proof. And when you looked at it, there's just all these little dash marks to show that it's footing in every, or it puts a cross in every row. And the dash marks are so small and subtle, if there's like 100 of them, you just don't see that one's missing. And then it took us like a day to figure this out, because it was a big provision. And we're like, holy cow, right? They have a one-sided journal entry in their account roll forward. I mean, that will not work. You will not be able to finish your provision by doing that. So it's a great move to kind of buy yourself some time, but it's not going to finish the day. Every row, when you're telling the story to get from last year to this year, every row has got to be a balanced journal entry. Proving out the current payable and receivable. When we do this roll forward, we're going to get to these balances like the as calculated payable. So we need to prove that, right? We get to a balance, we got to then prove what is it? Why do we need it? If it says we owe $100 in our payable, Well, then we got to go prove we owe $100. And sometimes it might be really basic, right? We had a $100 provision, we didn't make any payments, we must owe 100. Like, that's really simple. But a lot of times there's a lot of items that make up what that payable balance is, right? So it could be just our typical expected liability, like I was just saying. It could reflect payments. It could be non-U.S. liabilities. It could be IRS adjustments, amended returns, refund claims. You got to figure out all the things that you either owe money on or are owed money, and make sure that the aggregate of those things are captured in your payable balance. Right? But whatever that ending balance is at the end of the year, you should be able to prove that balance to all the sources of either inflows or outflows of money. Does that make sense? So this would be a typical payable proof. Right? I mean, there isn't really this isn't technical accounting type stuff. This is just common sense. So if you think you have a payable, you have an expected payable, you better be able to explain, well, what are all these things? Why do you owe money? Why are you owed money? Okay. I understand that whole discussion about accounts and roll forwards, man, it's really hard to appreciate without actually doing it, so we'll hit it with the problem tonight. Okay, it'll make more sense. All right. Any questions right now? Prepare the rate reconciliation. You guys do rate reconciliations in the homework last week? Did we make you do rate reconciliations? No? You guys are like mute if I don't call on you specifically. Terrible.
I have a question about the perform rate reconciliation. I understand that that the items that cause the ETR to vary are the permanent items, but the second bullet that says items that represent a temporary difference but are not tax effective, what does that mean? I mean, I know the word, but what does it mean? Can you give an example?
This is these are like trick questions, honestly. So this is like officer's life insurance, for example. So if a company pays let's say a company has a policy on its officers, and the value of that cash surrender value is going up and up and up. They put $100 in, now it's worth $1,000. So there's been a $900 gain on that insurance policy. That $900, not income to you, right? If you end up cashing out that policy because the officer dies and you collect $1,000, the $900, never income, right? If you end up cashing out the policy just for fun and the officer didn't die, the $900, income. So that sort of item can be a temporary difference, but if you represent that you're going to hold the policy to the death of the covered employee, then it wouldn't be a temporary item. So it's a temporary difference without a tax effect at the end of the day. But honestly, I wouldn't focus on that sort of thing. It's said here in the slides for being comprehensive, but this is not the thing you should focus on. Focus on perm items impact my effective tax rate. Don't worry about the brain damage stuff here. Okay? So perm items, credits, valuation allowances, right? We learned about valuation allowances last week. So does a valuation allowance, when you look at the rate reconciliation, does that increase your rate or decrease your rate? Joyce? So I have a loss, I'm AMD. I got building an NOL, I have to increase my valuation allowance. What does that do to my rate? Does that increase or decrease my rate? can ask your neighbor if you have a neighbor. Does that increase or decrease my rate? Somebody help Joyce. Increase, right? So a valuation allowance is basically saying, I had a loss that would normally give me a benefit, but I can't book that benefit because I don't think I'm going to have future income. So I'm effectively disallowing that benefit, right? I'm treating that loss as if it's like non-deductible. So increasing a valuation allowance will increase my effective rate. If I'm into it, right, when you read Intuit's 10K, they had a valuation allowance. If they suddenly said, oh, you know what, those state credits I have that I had the valuation allowance on, if I can use those all of a sudden, they would release that valuation allowance. And they would say, hey, this is great. You know, I can actually show this asset to the reader, whereas before I didn't think the asset was any good. So I get to debit asset credit provision. And so the release of that valuation allowance will lower my effective rate, right? Because I get a provision benefit. So a valuation allowance is permanently changing how much deferred assets I show in my books. So it's permanently changing the amount of provision I show because I'm permanently impacting step 2 of my provision with the valuation allowance. Okay. Yeah, so Veronica's question was, if you release a provision, is the entry credit provision and debit deferred asset? That's right. Remember, the valuation allowance is just a contra asset to the DTA balance, right? So, in effect, by putting a valuation allowance on, it's like we wrote off the DTA, just like writing off a bad debt reserve, or writing off an accounts receivable balance with a bad debt reserve. But just like with a bad debt, if somebody says, oh, I'll actually pay, but you had reserved the whole receivable, you're like, this is great. You know, I wrote off the asset, but then suddenly I collected cash, so now I have income again. The same thing is true with tax assets, right? If I booked a DTA and I said I can't use it, it's like it's not there. But then suddenly I said I can use it, it's like I found an asset. But it's a tax asset. It's not a receivable, it's a tax asset. So I would debit DTA credit provision. There's no payable element to that. So when I go through step 1, 2, and 3, there is no payable element in step 1. There is a deferred adjustment in step 2. So step 3 means there's a provision effect. You good with that?
So you would be lowering your provision.
In that example, we would be lowering our provision. All right. So rate reconciliations. So sometimes when you look at rate reconciliations, sometimes you see long rate recs, like there's a lot of items in them, and sometimes you see really short ones, right? Like remember Disney's was pretty short. It only had like 4 items. If you read, one of my clients is a competitor to Morningstar, like the mutual fund rating service, and I remember I pulled up Morningstar's 10K once just to see what their 10K looked like compared to my client, just to compare the two. And Morningstar's rate reg must have had at least 15 things on it. And I'm like, wow, right? That's a ton of information. And so you might wonder, well, why did somebody put 4 and somebody else put 15, right? The rule is you're supposed to reconcile the significant items between the statutory rate and the effective rate. So what you define as significant, obviously, is a little bit subjective, but the general rule is significant means items that are individually 5% of the expected income tax expense. So if you said I had 1,000 of PBT and my statutory rate is 350 or 35%, I would start my rate rec with 350. That would be my expected expense. 5% of 350 would be 17.5. So that means any item I have that changes my provision by more than 17.5, I should call it out separately in my rate rec. So if it's greater than 17, I show it. If it's less than 17, I generally put it in other. Right? Everyone kind of has an other row in their rate recs. And that other row is for these things that are less than 5% of the expected provision. Sometimes when you see rate recs, sometimes they're shown in dollars and sometimes in percentages. The rule says you can do either way. Okay? So some companies choose one, some companies choose another. Which one do you think is better? What's better? Connie, what do you think is better? Say it again?
Yeah, I believe the other.
Oh, I can't hear you.
Okay. So I think if they group as other,
If they group it as other, group the whole thing as other. No, but if you showed a rate reconciliation, like in our class, we've been doing it in dollars so far, because we calculate the total provision in dollars, and then we try to reconcile it to the expected provision in dollars. And it helps you guys see how the numbers come together. But I think, I mean, my personal opinion is that percentages are way easier. Because if somebody shows their rate rec as, you know, I expected my rate to be 35, I had a R&D credit for 2, and therefore my rate is 33%, man, I can instantly understand that. That is really easy. But if somebody puts in a bunch of numbers, I got to sit and do the math and try to figure out what the relative weighting is, and it just takes a while to process. You know, it just depends how good you are with numbers, I guess. But it's just harder on your head to actually take a rate rec and get it in your mind what the main drivers of the rate are, at least on a relative magnitude. But it's just math. I mean, you get the same answer both ways. It's just a matter of how you like to digest data. Okay. The rate rec on the exam will be more complicated than that. Okay? How's that for a hint about the exam? Okay, I feel like you guys are pretty on to the rate recs, and we'd be better off by using our time going through an example. So, you know, throughout the decks we have these little things to remember items. This one is profound. If you don't reconcile your provision with a rate rec that works, the provision is not done. Okay? That will be true on the exam. Okay? You have to do step 1, 2, and 3. You have to come up with journal entries. You have to do a rate rec, and it all has to work. Meaning the rate rec, you have to be able to reconcile between the statutory rate and the provision to the effective rate. Okay? That's key. Okay. In-class exercise number 1. Calculate the year 2 provision. Man, this is going to be awesome. Okay. So, let's now, I'm not sure how to show this on my screen. Okay, so we are going to do the year 1 provision. Oops, I don't want that. Okay. So let's just talk about the facts. And then you guys are going to work on this together with groups. And I suspect what we're going to do, since this is a year 1 and a year 2, is we'll stop after year 1 and we'll go through it. And then we'll do year 2. Okay? Okay, so let's just talk about the facts, make sure we're totally clear. Company with book income of 10 million. Penalties. Perm or temp? Brittany. Perm. Bad debt reserve. Marianne. Tax depreciation excessive book. Megan. Meals and entertainment. Neha.
It's 50% permanent.
Permanent. I added an L there to your name. R&D credit for federal. Ziad. Did he have an epiphany and a second thought on that? Perm, right? There we go. So that credit is going to permanently reduce the amount of tax we pay, right? So assume through this example that that's a reduced credit, if you know what that means. Reduced credit. For federal. Assume the same thing for Michigan. I don't know if they even have that, but okay. So we have an R&D credit for Michigan as well. We obviously file a federal return, and then we file 3 state returns. During the year, we made these payments. All right. So let's stop there. So why don't you do the provision based on that data for year 1. Okay? And what I want you to do is do step 1, step 2, calculate your provision, do the rate rec, but get ready to start doing an account roll forward like the one we showed in the slides. Okay? So just like we started in the first night of class where we had that Excel table where we had across the top the different accounts, then we had down the side the different journal entries, start to create that table. Because we're going to take our balances in every account, every column, we're going to roll them forward. Okay? And the great thing for you is we start at 0. Okay? So our year 1, day 1 balance in the payable is 0. But we're going to accrue a payable because we have a provision, and we're going to reduce a payable because we have payments. Right? We're going to do that for Fed. We're going to do it for state. We're going to move our deferreds. We're going to roll forward our beginning balances to get to our ending balances. Okay? It's key that you come up with that roll forward schedule, because then when we go to year 2, we're going to keep rolling forward. Right? Just like a big company does a provision. Every year they just keep on rolling forward what they had last year. Roll it forward, fix it. Roll it forward, fix it. That's what we're going to do. Okay? All right. So do that provision. Assume that we get a current deduction for our current federal deduction for our state tax. And then tell me when you think you guys are ready to chat that through. Okay?